Today, I want to talk about the giant short squeeze that just happened before our very eyes in a matter of minutes. I want to talk about what actually caused this giant squeeze and how the AMC squeeze will be slightly different, giving us more time to capitalise. So stay tuned and let's make some money. And now I'm going to dive straight in with the key information. So, Edward Burchuk tweeted saying, "What in the Ponzi scheme is going on here? Ticker symbol SLND randomly went to $2,000 per share today, like HKD did a few months back." So we can see here on Webull, ticker symbol SLND, which rocketed from $8.48 per share all the way to a high of $2,000. Now, I think one of the most interesting parts for me is that this didn't happen during the pre-market. It didn't rise and fall during those pre-market hours, locking out us retail investors. We can see from this video at 11.05 and 11.10 the stock was still priced at around $9, but come 11.15 it had rocketed to $2,000 per share. Now that tells me two separate things. Number one, these shorts can be caught off guard during market hours and not just during the pre-market where many retail investors can't trade. And number two, it tells me when these shorts do get caught out, our entire lives can be changed in 5 minutes or less. AMC could be trading at 2:30 in the afternoon at say $4 or $5 per share, and then 5 or 10 minutes later it could rocket up into the thousands of dollars for each and every share. Now if we then zoom in, this stock proceeded to then come down fairly quickly over the next say 4 or 5 minutes. But I actually don't think this squeeze lasted more than a few minutes to a couple of hours, and it was game over very, very quickly. Now, while I do think that AMC short squeeze will be over fairly soon, because that's the nature of a short squeeze play, I don't think it will play out in, say, 5 minutes or less. I think that AMC squeeze will take a few days at least. The reason why I say it's going to take a few days and not a few hours is because it's not just one shorting hedge fund that needs to be liquidated. There's potentially hundreds, if not thousands of hedge funds that are currently shorting AMC. And you may remember that when a hedge fund receives a margin call, it has say 4 or 5 days to meet the requirements of that margin call before they're forcibly liquidated. Therefore, some hedge funds may receive a margin call and realise there's absolutely zero chance they can ever meet the margin call being liquidated instantly. But some of those larger hedge funds may take a day or two or even a full 4 or 5 days to process that liquidation. But as Edward Burchuk tweeted, he said it's likely that this stock squeezed so quickly and so rapidly because of the insiders or the institutions that were currently long on the stock. He said, of course, you look at the institutions inside it, and of course it's got Citadel Advisors, AQR Capital, aka Cliff Asners, and all of the fraud banks together. Obviously, you've got Citadel holding, say, 500,000 shares, Barclays Bank also holding 500,000 shares, AQR Capital, and a number of other investment funds all holding shares. Now, this stock could have been used as a very, very quick pump and dump to generate additional liquidity to meet a margin call elsewhere. And I actually say that at a very interesting time because Business Insider posted an article yesterday and then changed it very quickly, saying that Steve Cohen's Point72 files for bankruptcy protection. Now, I don't really think this is fake news because it didn't come from a website like 123news.cz. Definitely not fake.com. Business Insider is actually one of the largest mainstream media outlets, so why exactly were they reporting on Steve Cohen's bankruptcy protection? Well, as David Neo tweeted, he said, "I'm starting to believe that Point72 is actually getting liquidated and they're possibly preparing for bankruptcy protection if they've not already filed it." He said shills were quickly sent to remove these news sources, but today's market move, aka yesterday's market move towards the close, is making him believe that big players are in trouble. And he said if this is true, then expect some fireworks after hours or in the next 4 trading days. He said they could be closing their long positions first, and then they'll try and close their short positions after. Now you may say, Tom, why specifically might Steve Cohen's Point72 be liquidated? Were they actually shorting GameStop and AMC, and are they still? Well, back in January of 2021, to be very specific, January 28th of 2021, Steve Cohen's fund, Point72, suffered a 15% loss amid the GameStop frenzy. Literally overnight, Steve Cohen lost 15% of his net worth and his entire fund in one singular day. Steve Cohen obviously held a large GameStop and AMC short position and likely still does, as he's likely stuck in that short. Now, as I said yesterday, these shorts are very likely stuck in their short positions, and actually there's some very simple logic that proves that these shorts are actually stuck. because these shorts would clearly happily pay 600% to 1000% cost to borrow, because to them it's cheaper than closing out of their short. They're realising that actually we'd rather pay 10 times our short position on an annual basis rather than close out of the short because of the dramatic impact it would have on the AMC price. They are clearly choosing and saying, can we close our short positions at $4 or $5 per share? Well, I guess the answer is no, because instead we're going to pay $40 or $50 per share every single year to borrow the stock. They're literally looking at like a $3 or $4 profit per share if they short AMC into bankruptcy, and to try and do that they're willing to pay 10 times the amount of the shares cost on an annual basis just to borrow those shares. Therefore, these shorts are clearly stuck if they're happy to pay 10 times the annual short cost to continue shorting, because clearly to them it's cheaper to pay 10 times the cost than close out of their position. And I think there's also something that proves that these hedge funds and these shorts are closing out of their long positions first, and then closing out of their smaller short positions in volatile names like Coinbase, Affirm, Carvana, and many others, and leaving AMC and GameStop until the very end. As Florian tweeted, he said over the past 12 days, hedge funds covered more US tech shorts than at any point in the last decade, except the meme blow up in January of 2021. You can see from this chart the current short covering is massively up compared to pretty much every single month or every single year on record. The only time that shorts covered more was back in January 2021, and therefore what I'm seeing right here is that shorts are covering their smaller short positions in smaller names and leaving their AMC and GameStop shorts until the very bitter end. So what we're seeing here is the shorts are leaving their AMC and GameStop shorts to the bitter end, and that it's actually cheaper for them to pay 10 times the actual stock's price to continue shorting, and they're also still pumping and dumping random companies as needed to meet those margin requirements. And now I think the reason why these shorts are so desperate and currently stuck and causing short squeezes left, right and centre is because of AMC on the threshold securities list. As Stonks Batman tweeted, he said you either go on the threshold securities list due to too much buying without locating or shorting without locating. As I spoke about in one of my previous videos a few days ago, we're actually causing these shorts to lose tons and tons of money and causing them to be more and more stuck by buying AMC shares, because obviously Citadel has to fulfill our orders at our buy prices when they can't even locate shares to sell to us. Stonks Batman added, saying, here are the last 3 times that AMC was on the threshold securities list, including now. And he said, does the third time or the current time have similarities to the first or second time? So we can see the first time AMC ended up on this threshold securities list was at the very end of 2020, when AMC had just gone through a 3 or 4 year cycle of being very heavily shorted. AMC was shorted from 2017 at $30 per share all the way down to the very end of 2020 when it reached only $1 or $2 per share. The shorts had clearly applied maximum shorting pressure to the point where they couldn't locate any more shares to short, and therefore AMC ended up on that Regulation SHO threshold securities list. The second time AMC was on the list was back in June after that massive June run-up, and that's because we had so many retail investors and institutions buying AMC shares that these market makers couldn't locate a single share. You had institutions going from owning 20 million shares up to 180 million shares of AMC at the very peak, and potentially likely many more that were potentially unreported. You also had retail investors buying 90% of the float, or likely buying the float multiple times over, and that's why Citadel and those market makers couldn't locate any shares to be sold. And right now again, AMC is on the threshold securities list for the 3rd ever time, and I personally think it looks like we're currently on the threshold list right now for a similar reason to the first occasion. AMC has obviously been shorted down from these highs to these new low areas. These shorts obviously went all in with their shorting, and that's why these market makers can't locate any more shares. But obviously it's not a great time for these shorts to be running out of shares, because obviously we've got Point72 filing for potential bankruptcy protection. We've got short squeezes happening left, right and centre to generate additional liquidity for these hedge funds. And we've also got a record amount of short covering. And all of that's leading to these shorts currently paying thousands of % interest on AMC shares per year, because doing that is cheaper than them actually closing. And this also comes at a terrible time as we're still in this potential downturn, potential recession, where even Apple has now begun firing contractors amid massive tech layoffs. Apple is literally taking the decision to fire basically everyone instead of taking the decision to improve their products and make more money. Tech layoffs right now are at all-time highs, even higher than they were back in 2000, 2001 and 2008. And obviously if the stock market crash does continue, which I think that it will, all of these hedge funds will be losing even more money on their long positions and getting closer and closer to bankruptcy. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.